Hello and welcome to FA1, Recording Financial Transactions, Chapter number 2. Chapter number 2 looks at a general introduction to accounting. And what we're going to do within Chapter number 2 is give you a basic understanding of the types of business organisations that we can deal with, and then we'll start having a look at the type of financial statements that they can prepare. So, to start with, what we're looking at is the types of businesses. And we start off with a sole trader, and then we'll talk about a partnership, and then we'll talk about a limited company. Now, with a sole trader, what happens is an individual is trading for themselves. So an individual is trading for themselves. And what now happens is that sole trader buys things, does something to them, sells them on. They make the profits. They keep all of the profits. They are effectively the business. So with a sole trader, the person who's doing the business is effectively the business in itself. So everything is exactly the same. With regard to a partnership, what tends to happen is a sole trader becomes too big, he gets too popular, maybe a little bit too competitive and make lots of profits. He now becomes too busy and he now needs to get somebody else on board. That somebody else, when they join, now turns the sole tradership into a partnership. So multiple sole traders working together becomes a partnership. This partnership is not a separate legal entity. The partners own the business. The partners are the business. The partners are still fully liable for everything which goes on within that business. Then what happens is the partnership grows again and they need an additional injection of capital. And this is when we get to our limited company. A limited company is a separate legal personality. So it's a separate legal personality, which means it's completely separate and distinct from all of the directors who run the company and the shareholders who own the company. It's a completely separate legal entity. The limited company accepts liability for all of its own actions. So the company accepts liability for its actions, which is why it's called a limited company, because the shareholders, i.e. the owners, liability is limited and they're not liable for the company's debts. They're only liable for their own debts. So this limited company can then go off and trade and do whatever it fancies doing. That limited company can potentially become a listed company and be listed on one of the international stock exchanges. Now, the types of persons we're interested in looking to satisfy here. We need to understand what these different types of businesses are. Once we know who the businesses are, we can then start thinking about the users of the financial information that they produce. And the users of financial information will include parties such as managers of the businesses, owners or shareholders of the business, suppliers, customers, financial analysts, if you're a PLC which is listed, the government itself, and also the tax collection agency within the government will be very interested in this, also pressure groups. So what we as accountants have to do is try to provide sufficient information to allow all of these different user groups. So we need to provide sufficient information to allow all of these user groups to have their informational needs satisfied. So we need to make sure that we can make sure that all of these different user groups have their informational needs satisfied. To do this, what we do is we have two different styles of accounting. We have financial accounting and then we have management accounting. Financial accounting looks at historic transactions. So financial accounting looks at historic transactions. Financial accounting will produce financial statements, which we're going to look at in just a second. Financial accounting will always try to make sure that our external users, primarily our shareholder group, they get the information that they need. So financial accounting tends to focus on external user groups. Also, financial accounts, financial statements, they tend to be made publicly available, which is why they are used to satisfy external user groups. Management accounting, which you'll cover within your MA1, MA2 papers, management accounting is used for decision-making purposes by managers. Now, management accounts can be in any format whatsoever, as long as the users, i.e. our managers, can make the right decision. That's fine and dandy. I don't want to go into a huge amount of detail with regard to management accounting here because you've got an entire paper of MA1 which we'll look at, which does nothing but management accounting. So coming back to my financial accounting, what we have is what we call our primary financial statements. So these are our primary financial statements, and we have got the income statement, which is also known as the profit and loss account. So we have the income statement, which is also known as the profit and loss account. We have the statement of financial position, which is also known as the balance sheet. This income statement is basically a statement which gives me a story of what we've done over a period of time. So it's a performance evaluation story. So my income statement, my profit and loss, shows profits and losses for a period. The statement of financial position, also known as my balance sheet, that gives me a financial snapshot of the business at a specific point in time. So that gives me a snapshot of the business at a specific point in time. Now, these two statements by themselves may not necessarily give all of our external users all of the information that they need. So what we do is we give notes to the accounts, which will explain specific numbers within the income statement or the statement of financial position, and it gives the numbers in more detail, shows you how they're made up, how we've worked it out. And then we also have narrative reports, because not everybody will understand what the numbers are trying to say. So the narrative reports try to give you the information in words so that you can then work out, oh, I understand what they're trying to say to me now. So you might get a much better understanding of what's going on within the business. Now let's have a look at these financial statements in more detail. The first primary financial statement we're going to look at in a bit more detail is going to be my statement of financial position. Now my statement of financial position gives me a financial snapshot of the business at a specific point in time. And what it does is it tells me all of the assets and all of the liabilities at a specific point in time. In addition to that, it tells me about my ownership interest. Now, the ownership interest should be seen as a really, really super long-term liability. So think about the ownership interest, the capital, as a super long-term liability. Once you understand that, the format of my statement of financial position suddenly makes sense. Now, I need to have an understanding of what assets and liabilities are to start with. And what I would like you to do, guys, is in your notes, if you turn in your notes to the actual pro forma statement of financial position, as we go through this, everything will start making a lot more sense. So what we have is a definition of an asset or a liability, which forms around three different things. Here's a multi-choice question if ever we saw one. So these three things are critical for an asset or a liability to arrive and to crystallize. There has to be a past transaction or event. That past transaction may have been a sale, it may be a purchase, may have been something else such as a court case. Economic benefits have to flow. If this is an asset, economic benefits will flow into the business. So if this is an asset, economic benefits flow into the business. If this is a liability, economic benefits flow out of the business. We then have the control aspect. We can control how those economic benefits work. So we can control how those economic benefits work. So we can determine when they're due to be received or when they're due to be paid. However, the control is important to me. Legal ownership is not important to me. Legal ownership is not included in this definition. That is essential. So legal ownership is not included in this definition. Now, within our assets and liabilities, if you have a look at our pro forma statement of financial position, what you can see is non-current assets, then non-current liabilities and current liabilities. The difference between current and non-current is all about the timing of the economic benefits. If the economic benefits are going to come in, it's an asset, or if they're going to go out as a liability within 12 months, then it becomes a current asset or a current liability. So if the economic benefits will flow within 12 months, that now becomes a current asset or a current liability. If they're going to flow over a period in excess of 12 months, it becomes non-current. So if you have some property and you're going to use it for the next 10 years, that's a non-current asset. If you have a bank loan and you're going to pay it off in 10 years, that's a non-current liability because it's greater than 12 months. Now that's all well and good with regard to assets and liabilities. Now we need to just think about the capital. Consider capital as my ownership interest as a really long-term liability. So this now means that the liability will only be satisfied when the business is closed. So this liability will only be satisfied when the business is closed. And this liability can be calculated as the amount which was originally invested, so the original capital put in, so the amount that was originally invested, plus any profits that we've made, and you can actually see profits as being an increase in assets, minus any drawings. So that's the amount that we've taken out from the business. And what we've got is an example here which just illustrates how this works. And if you flick through to example number 1, what I will do whenever we come to these examples is I'll jump into the spreadsheet. Here's our spreadsheet. And what I'll do is actually go through the example to illustrate to you how to answer these style of questions. So it's not just the fact that you can get to the answer, it's the fact that you can understand how to get there. So what we have is Caroline started a flower shop on the 1st of January, investing $5,000. So what now happens is, during our year ended 31/12/7, we've got the amount that was originally invested. And what I'm going to do is I'm going to call this my initial capital. And the initial capital going in is going to be $5,000. In the year to 31 December X7, the shop earned a profit of $2,500. So we then need to add on the profits, $2,500, and Caroline has taken $1,000 worth of drawings. What I'm going to do is I'm going to subtract the drawings. And here's another convention here, guys. What happens is if we have a negative figure, we normally put it into a bracket. And what I've done is I've set the format up here, so when we take this 1,000 out, it comes up as a bracketed figure. And what that now does is it allows me to work out the total amount of ownership interest at the end of the first year. So that's as at 31/12/7. Next, what we can do is we can look at the next year. And what we've got is the brought forward capital, which will be the amount of 6,500 that we already had from the previous year. And then the question goes on to say that in the year to 31 December 2000X8, Caroline has introduced a further 2,000. So we've got an additional investment. And the additional investment is an extra $2,000. So we can add that $2,000 on. The shop made $7,000 worth of profit. So I've got my profits, which I'm going to add on, which is another 7,000. And Caroline took drawings of 2,000. So I've got my drawings minus 2,000. This will now give me a total for my overall capital balance or my ownership interest as at 31/12/8 of 13,500. Now, hopefully that makes sense, and you can sort of see how the impact of money being introduced and extra profits and money being taken out has quite a significant impact on this ownership interest, on this overall total amount of capital. Now, the next key financial statement that we're going to look at, so the next key financial statement we're going to look at is our income statement. The income statement is designed to give us a story of what's happened over a period of time. And the income statement works by looking at things such as sales and then takes away cost of sales to get to gross profit. Now remember from chapter 1 we were talking about the difference between purchases and expenses. If you've got a purchase of something, you've bought something and you're going to sell it on somewhere else. With that type of purchase, that purchase goes into cost of sales. Notice within cost of sales there's a purchases element. So my income statement says, how has my business performed? And it does that by looking at a gross profit figure. The gross profit figure, so the gross profit figure is the result of our core trading activities. If you end up with an overall negative figure, a gross loss, you're probably in the wrong business. That now means I can make a decision. We then take into account any other type of income and expense items, and then we get to our net profit or our net loss, which includes all of those expenses we were talking about. If you end up with a net profit or a net loss which is negative, so you end up with a net loss, but you've got a gross profit figure which is positive, that now means you need to reduce your expenses. So again, there's decision making allowed to come out of this. Now, this income statement tells me what my profit or loss figure is for this period. It breaks it down into various different component parts. That makes it amazingly useful. Now, hopefully that makes sense to everybody, guys. As I said, do make sure that you're comfortable with these two key primary financial statements. Make sure you're happy with exactly what's going on with regards to the layout. Have a little flick through them. We're going to start going through all of these things in a much more detailed approach to make sure you've got a keen understanding of everything. That brings us up to the end of chapter number 2. Make sure you have a go at the online portal questions. Apart from that, thank you very much for your time and attention. I'll see you all bright-eyed and bushy-tailed on chapter 3 very soon.